way Rob presented this, when you have a chance to sit down with your advisor, the next time you might want to suggest that they put away the spreadsheets and portfolio analysis and just focus on one takeaway from Rob's presentation. You only have to really worry about what's behind door number 2. So when you come in, just ask for what's behind door number 2, because Rob has said there'll be just buckets of money. I'm going to talk about some other asset classes and the impact, but also on equities as well, of eventually higher interest rates. So we're looking at fixed income, equities, real estate, and other asset classes. Now, in presenting or putting together this presentation, both Rob and I spend a lot of time putting together the slides, and then we try to find people who will let us practice on them. Now, my wife has already told me that she won't do this anymore, but fortunately, I've just had a new granddaughter. She's 2.5 months old, and her name is Lily, and I managed to catch her at a moment. I put her in a chair, and I went through the slides, and after 3 or 4 slides, I just looked over to her. Now, she can't speak, of course, but this is really what she was going to say. So I have a feeling next year I'll be practicing on my own. One of the issues with forecasting is it comes down to the issue of predicting the future. And I'm sure nobody here is old enough to have actually attended the 1939 New York World's Fair. Its focus was, I have seen the future. And they, at World's Fairs, you like to project the technology you're going to see in the future and 20, 25 years out. And back in 1939, they said by the 60s, you would, for instance, have your own robot in every house, including having a robot dog. I particularly like this picture because I don't quite follow why she feels the need to feed the robot dog. And the other thing that was amazing is the technology in automobiles back then. The prediction was that you would get see-through cars made out of plastic. Now, I have no idea why anybody would want to have a see-through car. They're highly impractical at a drive-in movie, so I don't really follow, but anyway. So I was looking up forecasting because, unfortunately, it's like an oxymoron. Accurate forecasting is just something that is very difficult to achieve in any aspect of life. So if we take a look, I was Googling around and I came across this thing. It's called a weather forecasting stone. And you can just find a stone, drill a hole in it, hang it up in your backyard, and you will be accurately able to tell the weather all the time, any kind of weather. Here's basically how it works. So if the stone is wet, basically it's raining. If it's not wet, then if the stone is dry, it's not raining. If there's a shadow on the ground, it's sunny. If it's white on top, it's snowing. If you can't see the stone, it is foggy. If it's swinging, it's windy. And if it's jumping up and down, there's an earthquake. And if it's gone, you've just had a tornado hit your house. So it seems to me that people go to school for meteorology degrees that take 4 years. And here's something that works, and it really virtually costs nothing. So what we're looking at is comparing economic forecasting to weather forecasting. So how do the two compare? Well, according to Homer Simpson, his question would be, why did God create economists? Because they make weather forecasters look good. So with some humility, what I'm going to do is go through the problems with us actually trying to predict the future and use it to drive wealth-building strategies. So I'm going to give you some examples of some of the smartest people in North America in terms of both investments and economics, and some of the things that they predicted or said over the last year or two. So we'll start with a fellow named Jeremy Grantham. He runs a very successful fund, $120 billion management group in the US, has had a very good track record. And every year he comes up with a 7-year forecast of how different asset classes are going to perform. And last year's predictions were that for the next 7 years, the only place you could get decent returns would be emerging markets in timberland. And if you were investing in large cap equities or bonds, you would have negative real rates of return for the next 7 years. So, more than a bit gloomy. Another person who we know personally, his name is John Mauldin. Some of you may be on his newsletter. He's written 2 very good books about the debt situation and has analyzed, in particular, government debt, fiscal issues around the world for a lot of years and done a great job at it. For example, he said in this particular article that unfunded liabilities of most major governments are approximately 4 to 5 times the official government debt. At these levels, it would be impossible to fund the medical liabilities, the pension liabilities that most developed countries have. And because of that, things are going to change. So he's relatively bearish for part of the reasons indicated here. He has a conference every year, and we attended last year. We're going to go back again this year. And every year, there's some very, very good speakers. And the questions that get asked, last year the questions that were asked are, what were their favorite asset classes? Are interest rates headed up? If so, how much and when? Will the euro survive? That was a bigger issue last year, of course. Inflation or deflation? The US dollar, stronger or weaker? And if all of these central banks are printing all of this money, why is gold not performing well? Because obviously it is not. So, who are these very bright people? They include an individual named Niall Ferguson, who's written many books and is a Harvard economics professor. A man named Nouriel Roubini, who's otherwise known as Dr. Doom for his bearish views on most markets. Gary Shilling, a very successful investment manager and economist. Mohammed El-Erian, he was the co-CEO until recently of PIMCO, the largest asset manager in the world. And David Rosenberg, who's the chief economist of Gluskin Sheff. So this is a fairly big brain trust. So let's just take a look at 4 particular predictions made by some of these individuals over the last little while. So starting with Jeremy Grantham, who we started with, he said at the beginning of 2012, 2013 would be a very tough year for stocks, dangerous, and the S&P, of course, rose 27%, not including dividends, the following year. David Rosenberg predicted the Canadian dollar by this time, 2 years ago, he said in 2 years' time, the Canadian dollar will be $1.15 US. Gary Shilling, who's had a very good history with investing in long-term bonds, predicted that 30-year bond rates would drop to 2% from last year's level of about 3. Well, now they're at 3.7, and if you'd taken this bet a year ago, you would have lost 25% of your capital, even though you're investing in government bonds. And John himself has been bearish on equities more or less since 2000, which is fine as a particular strategy, but it means obviously that in the last 5 years he's missed roughly about 140% run-up in the S&P 500. So where does this bring you with the issue of forecasting? Well, Lao Tzu said, those who have knowledge don't predict, and those who predict don't have knowledge. I think Yogi Berra probably said it a little more cleanly when he said, it's tough to make predictions, especially about the future. So having said all that, we're now going to get into some forecasting, but I just want to have a caveat. I would like to change the word forecasting into projections, if that's all right.